Good morning, everyone. Good morning. Glad to be here this morning. Glad you guys are here with us. Big Life Financial Services is in the house. I see that Donna, Cole, and Karen got up nice and early to greet us. And so I want you guys to take some notes. So get pen and paper. Hopefully we're going to, drop some really good information on you that for some of you guys can really change your lives. So the Big Life family, the Bennett Realty Solutions family is in the house. And so I have Joan Lane and Donald Williams from Big Life Financial Services here to help me along with this talk. Why don't you guys introduce yourself? Why don't you go first, Donald?
Oh, wow. Thank you. Thank you, Greg, and good morning, Joan. My name is Don Williams. I'm from the great state of Maryland, born and raised Washington, D.C. I've been into financial services for the last 10 years now. When I first got in it, I saw a need to be able to get better financially educated. Some of these concepts and how money works is not taught in high school or college. And so once I learned, I like to call it the secret of money. I've been on a sort of a crusade to do financial education, financial workshops, seminars to help people understand how money works, how life insurance works, how to build a retirement, how to get totally out of debt. So I'm excited to be a part of Big Life and what we're going to bring to the table today. Thank you for allowing me to share.
All right, thanks for that. Miss Lane?
Hi, everybody. My name is Joan Lane. I am originally from Southern Virginia, but have been in the DMV for way too long. So I guess this is home now. Got into the insurance industry, I think in 2000, 2001, around the same time that I got into real estate. I was formerly a real estate broker. My connection with Greg is originally through real estate. Focused on real estate for a while. And after the market crashed, back in 2009, I decided to kind of shift my focus and really started honing in on insurance. I've done supplemental life, annuities, worked with a lot of work sites, heavy with federal employee experience. And like Donald said, the goal is to, especially to a underserved community, bring financial information so that we can actually give the tools and have people apply them to their particular situation so they can meet their particular goals.
Good. And so I'm glad you said that because, when you know better, you do better. And then you guys that are listening, you can go to the chat box along the way if you guys have any questions. But, and so contrast this. About 20 years ago, in my early 30s, and I knew I needed insurance. I didn't have any insurance. So I was recommended to this insurance person to sell me insurance. She was with a company. I don't know if I should name the company, but you guys
don't say it. I knew you were going to say, don't say it.
I didn't know what the company is. But anyway, she said to me, you should get this cheaper insurance. It's called a term policy. And you'll save money, and then with the money you can save, you can invest. So buy term, invest the difference. You guys have no idea what company that was, but anyway, and so I got the term policy. I tell this story all the time. I got the term policy, not knowing any better, because that's what was recommended to me, and so that's what I did. I got a 20-year term. Needless to say, I outlived the term. Once I purchased the property, never heard from the insurance person again. And so there was no one to tell me that maybe that term policy was convertible. Along that 20-year journey, I got sick. Like, to be transparent, I had a kidney transplant. So it was almost literally impossible for me after that 20-year term to get insurance again. I wasn't insurable. Fast forward 15 years later, my daughter had turned probably about 11 or 12 years old. I knew a little better. I was around more people. with better ideas and better knowledge. I was talking to a buddy of mine, and he recommended an index universal life policy for my daughter. And so I got that for her at that very, very young age. It was permanent insurance. It wasn't temporary. It was permanent. She was building cash value with that term policy that I purchased, no cash value. And so now she was about, I don't know, 12, 13 years old. She's 23 years old now. She has enough cash value in that policy that I actually just found a property in Prince George's County, looked at it yesterday. She's going to be able, because of that index universal life policy, to purchase this property on her own merit, her own credit. She has enough income. She bought a house for herself last year, so this will be her investment property. She's going to use the $25,000 that she's built up in her index universal life policy to put down on this investment property. So she's going to be able to buy real estate as an investment property. She's going to take a loan from herself, from her insurance policy, and then buy her first investment property. And so that's the power of having the right type of insurance policy. And that's kind of a backdrop of what we're going to get into this morning, and we're going to take a deep dive into everything I just talked about. Beginning with, and I kind of touched on it, Donald, but talk to us about the differences. There's two types of insurance. There's permanent insurance and temporary insurance. Talk to us about the different types of the insurances and the names of those types of insurances. Go ahead. What are the different types of insurance?
Okay, so first I just want to talk about the different types are, you have permanent and you have term. Permanent means that insurance can last you for your lifetime. Some of them go all the way up to age 120, 121 years of age. Term, which is what you had, has a level payment for a certain term period. Term is the least expensive type of insurance you can get, but you can get a lot of death benefit. Had that agent that you had 20 years ago or so, see, it was a good thing to put you in that if that's what your budget could afford. At Big Life, we have term policies that have what's called living benefits. So had you been in one of our policies, it could have been a term, let's say $1 million, and had you had that medical issue, by paying that very low monthly payment, you could have had possibly a check delivered to you for $500,000, $800,000, and to solve your medical situation. But also, had the agent been good, they should have been following up with you over those 20 years to say, hey, Mr. Bennett, you know, we can convert this term to a permanent policy. We can either convert some of it, some of the death benefit, or all of the death benefit into a permanent policy that will last you for a lifetime. So that's one of the things we practice here is term is, like I like to say, for immediate protection. Protect you, your family, protect your income. The whole life, the index universal life. Let's talk about the permanent policies. We got what's called whole life, index universal life, and universal life. Those are basically the three permanent plans, and those will accumulate cash. You can take out loans for those policies. You can use the cash in those policies for whatever you want. There's no credit check. It's based on what you have accumulated and how that policy is growing based on whatever index or whatever it's following. So it's a beautiful thing. You can take out loans. You can use it for your children's college education, retirement, to enhance your retirement. You can use it for real estate investment, for business startups, ventures, whatever you want. So those are the basically, you got your term, which a term, by the way, let's not forget, I can convert that term into one of those permanent plans. Okay. And you can have what's called a combo plan where you got a term and a permanent plan together, which is one of my favorites.
And so, Joan, staying on the IULs, What are some other benefits of having an IUL? How does that money grow in terms of like the compounded interest? Are there any can there be market if the market loses? Do you lose? Can you take advantage of the gains? Those type of things.
Okay, that's a good question. So with as Donald said, sorry, I forgot his name for a second. As Donald said, you have your UL and your IUL. They both have guarantees. With the UL, it's basically a guaranteed rate throughout the life of the policy, and it has a fixed floor, which means if the formula that they use to invest the money to give you your growth goes below zero, you don't participate in any negatives. You just have a zero for that year. People shouldn't be afraid of the zero. It means that you didn't lose anything. You didn't have growth, but most importantly, you didn't lose anything. With the IUL, the formula is to match the movement in the market. So that's how you're able to determine what your gains or your zero is going to be. But again, it's a guarantee. It's a fixed floor, zero floor. If it goes to below zero, which means a negative, you don't incur any losses, but you participate in any gains. The good thing, there are a lot of benefits to it. One is it's a tax strategy. In insurance policies, you do not have to pay taxes on income or distributions from your insurance policy. Now, it's important to know that you want to take a loan versus the withdrawal, because there are two ways that you can take the money out of the policy. When you take the loan, you're borrowing from yourself. And loans from your policy are not taxable. So you can overfund a policy to kind of expedite your cash value. You take that money out for whatever reason you want to, whether it's to invest in real estate like your daughter did, is to get out of debt, to pad your retirement. You can do whatever it is you want to. You don't have to, mother, may I use it for this purpose, or may I use it for that purpose? It's your money. You do what you want to do with it. You just work with someone like yourself or Donald or me, and we can kind of help guide you on to how to make that happen.
And so Donald, go ahead, Donald.
Yeah, I just wanted to piggyback on what Joan said. I don't want that to get lost on anyone. When she said you can overfund it, somebody might say, well, why would I want to do that? But that's how you properly design an IUL. That if to design that IUL correctly, and you want to get with a financial person like Joan, Greg, or myself that will design it correctly, overfund it. By overfunding it, we're maximizing our contributions without them being taxed. And the other beautiful thing about it is that IUL has a flexible premium payment. If for some reason 1 month you have a hardship or something like that, because we properly designed it correctly, overfunding it, we can always lower the payments while you go through that hardship, and then we can get them back resumed. So I just wanted to add on to that very important feature of the overfunding and how you properly design an IUL.
Absolutely, because with that that safeguard, we can tell you up front, if you have a hardship on any particular month, there's a minimum that you can pay to keep that policy from lapsing and still stay on track with everything that you're doing.
Absolutely.
And in terms of building wealth, I think one of the greatest things you can do for yourself, you can do for your children and your grandchildren, is keep those policies going. And so one last point, Donald, is I've got a buddy of mine who has a grandchild like you, 2 years old, debating whether or not to put a few $1,000s into the stock market, into some blue chip funds for the child, versus, and I'm telling them, open up an IUL, an index universal life policy, for your child. And so what's your opinion on that?
Well, my opinion is, and I'll never forget, I met this lady probably maybe 8 years ago, and she lives in Texas, and she's an agent. And she said, Donald, every time I have a grandchild born in my family, she opens up a policy on her grandchildren. She's got about 6 policies, all on her grandchildren. And somebody might think, oh man, that's taboo. You know, some people might be thinking negative on that, but she's not opening those policies because she thinks those children are going to die. You see, those policies are designed to gain more value the longer they live. The longer the person lives in a IUL or UL or permanent policy whole life, the more value the policy has. So now, whenever those children, when they become teenagers or going to college and they need some little funds, she just goes into she because see, she's the owner of the policy. When you as a grandparent or parent open up a policy on your child, you control all the money in the policy, all the cash, everything comes to you, the owner. The only thing, the child is just the insured. And it's a great vehicle to actually grow money. It's like a bank. I mean, you can get better returns on that. I like to say investing in that child with an IUL than you can putting your money in a bank with Mr. Banker giving you 0.05%, you know. So
or the stock market, because the stock market you do have gains, but you have losses too. Yeah. Putting your money in the IUL, you're protected against the losses.
And we have what's called $1 million baby policy concept, $1 million baby, where we can design one of these IULs with your little sweet little princess or prince at an early age, and that we design it, depends on your budget. It can take care of all of their college. When they get out of college, you want to buy them a car or a house, down payment on a house. When they become 30, you want to give a wedding for them. And it can also be a retirement plan for them, right? Now, what if they go astray and they're not where you want it? Well, you control all that money. You know, I always wanted a vet. Maybe I'll buy me a vet. Maybe I'll put her in trade school or whatever. It's your choice. There's no penalties if they don't use it for college, like some other plans that are out there.
That's a very good point, because if they do the 529, if you don't use it for educational purposes, now you have to pay the penalty on it.
Right.
And so they're better off starting their children and grandchildren off in a life product. But then also, all this comes with the death benefit. They can take over the policy at a certain age. So my daughter, she hasn't taken it over yet. She's going to take it over soon, but she hasn't taken over the policy yet, but she will. And then she can even overfund it and pay more, because as long as you guys know this better than I do, but as long as her cash value doesn't exceed her death benefit, which Joan, you can explain that better than me, which is called the MEC, she can keep increasing her premiums, which means, you know, her money's going to go up even faster, especially if the stock market does well.
You know, I want to say something just about mindset, because Donald was saying that some people may think that taking a policy out on a young person or a baby is taboo. We have to get it from the mindset that insurance is just a death benefit. The regular person is kind of slow to the game, understanding that insurance is actually a tool. Banks borrow from insurance companies. A lot of the foundation financially is based on insurance companies. So the smart bet is to get with an insurance company. Use it as a mechanism to fund your lifestyle, whether that's a working lifestyle, a retirement lifestyle, building for a future, whatever the case may be. And it's tax advantaged, meaning that more than likely you're not going to pay taxes on it. Now, as Greg was saying about the MEC, which is a modified endowment contract, meaning that when you have that excess over your death benefit, that could be taxable. So in most cases, we can guide you to intentionally not put it into a MEC. There are some times that it's okay to go into a MEC because you're dealing with such a high premium that the benefits will kind of work themselves out. And I don't want to get too into it and confuse anybody, but under the right guidance, you'll be okay.
if it goes higher, you have to pay taxes on that money, but it might be worth it.
You pay the taxes, right, on the difference. Yeah.
Go ahead, Donald.
Yeah, and the other thing I want to say, and this week has been kind of a challenging week for me, trying to actually put some policies in place for people with children. I can't get their children qualified for insurance. Their children have some major medical issues that they did not have those issues at birth. At birth, their children were healthy. In their younger ages, they were healthy. Now these children have some diseases. One of the insurance carriers told me that's a rare disease. Unfortunately, the younger the person is, it's more of a risk. If they live a little bit longer, we might can come back and consider them. Had that parent or grandparent just started with a small little plan, it could have been just $25 or whatever a month. And also design it correctly, put what's called a guaranteed insurability rider on there, or guaranteed increase rider, which we could automatically increase the death benefit without ever having to do medical exams in the future. But had those parents did that, those children would have life insurance now, and they could do the IUL. They could be, as their money on their job, they make more money. They can now start fully doing all the things that we're talking about today. So I'm now, like I say, this week, unfortunately, I had two and I'm now trying to explore some other carriers that I went through about 3 or 4. They will not give these children life insurance. And if we'd have got them set up early, we wouldn't have this problem.
And so for me, I feel like the greatest thing that I've ever done, I just have one child. I think, Joan, you're just one as well, right? Oh, you have 2. Okay. So one of your children in my Beverly went to elementary school together, Holy Trinity. But I do feel like the greatest thing that I've ever done for her was get her that policy, because she's going to have that policy for a lifetime. She's going to be able to build wealth with that policy. Done correctly, like Donald always says, that policy can turn into $1 million policy, done correctly. And so it's the greatest thing. And then she never has to, if she ever has any type of medical issue, she'll always still have that policy because it's a permanent policy. And so for those of you who are out here, I know right now we're talking to the parents and grandparents. We'll shift the conversation to, what you do when you're a little older. But one of the greatest things you can do for yourself, but for your children and grandchildren, is to get a policy that's going to help them build wealth. And, my background, most of you guys know my background is real estate investing. But when you combine these types of policies that we're talking about, that's growing cash value according to the stock market, along with taking that money out to invest into real estate, that's a lethal combination, you guys.
Another point to break up. I'm sorry, I didn't mean to talk over you. Just about the premiums, we're talked a lot about overfunding, but as a basis on a permanent policy, whatever premium you come in at, that's going to be it for the life of the policy. So, and as you get older, every year you age, that premium increases a little bit. So your starting point increases every year with your age. That's at the starting point to get in. But once you're in like Flynn. So let's say with Beverly and my Megan are 20. Well, Megan just turned 24. I'm sure she's got a birthday coming up. If we were to just be starting them on a policy, they could still get on a permanent policy. They could invest $150 a month, and at retirement be at $1 million. That base premium is never going to change unless they let that policy lapse. But if they get sick or whatever the case may be, as long as that policy is already intact, that's fine. So that's something you always want to keep in mind, that premium is not going to change. So you want to get in as early as possible. Now, it's not too late for people who, older people like us who had a term policy or they're relying on their, I'm sorry?
You said older people like us. I said,
Or people relying on their work policy. That's something I guess we should cover too. And then realizing that that group policy is a term policy, and that they need full coverage. They need permanent coverage. It's not too late. The rate is going to be higher, but it's not too late.
No, it's never too late. And so I think that also the point is when you're starting out paying your monthly payments, your premiums, the majority of that money initially goes towards the death benefit, and then a little bit goes towards the cash value. It's almost like a mortgage payment where the first 5 years of your mortgage payment, the majority of that payment goes towards the interest, and a little bit goes towards the principal. But as you go really past that 5 years, Donald calls it, it's got to cook in there, I think he says. I'm starting to talk like Donald too much. But on the insurance policy, once you get past that 5 to 10 year period, now the majority of the money is going towards the cash value. And so now, like Beverly has about $25,000 that she can take a loan from herself that's been accumulating over the years. And then when she takes the money out, it's still growing as if the money was still there. And then as we go within the next 5 years, it's going to probably even double, because now the majority of the money, that's the premiums that are being paid every month, now the majority of that is starting to go towards the cash value. One other point I want to make, and Joan, you made the point, life insurance, I really call it wealth insurance because it's a way to build wealth. And it has these benefits that we're talking about, but it has some other living benefits to it. And so Donald, talk a little bit about some of the living benefits, such as critical illness, long-term care, things like that you can take advantage of with these same policies, and add to these policies different riders.
Right. So a lot of companies will say that they have living benefits, and when we do policy reviews, we'll find out that the only living benefit they had was what's called a terminal illness living benefit. And a terminal illness means that the doctor says, we have no cure for what you have. You only have, in most cases, they'll say 12 months or less to live, and they diagnose you as a terminal illness, and so then you will be able to accelerate the death benefit if you needed it in those next 12 months to do whatever you want to do. So when we look at policies, our policies have more than just a terminal illness. They have what's called a critical illness rider and a chronic illness rider. And also, by the way, our terminal illness on some of our policies, they have what's called a 24-month terminal illness rider, opposed to the 12 months that we see out there. You might say, well, Donald, what's the difference? Well, if the doctor told me today I got 2 years or less to live, and I got a 24-month terminal illness rider, that means I can access that money right now. But if I only had a 12-month and he told me I got 2 years left to live, I got to wait till 12 months go by until there's only 12 months left on the calendar, and then I can get that money. And man, it's like, man, I want to do some things right now. So the other benefits, though, critical. There are about 16 different triggers. That's the most popular one that might get used in someone's lifetime. Heart attack, stroke, diagnosed with cancer. What is it? COVID, yeah. Does anybody know anyone that has come down with a heart attack, diagnosed with cancer, stroke, or COVID, and they survived? Does anybody know anybody that survived? Yes, almost everybody survives those type of issues. But what happens is you might get sidetracked for 90 days, 6 months, a year. That could affect your income. So with the critical illness rider, we're going to be able to accelerate the death benefit if you need it, and you can use that money to do whatever. Pay your mortgage, pay your your car, your kids' private school, college school, whatever. And then there's what's called chronic illness rider. That's when you cannot perform 2 out of 6 of your daily activities of living. Those 6 activities would be considered bathing. You can't bathe by yourself, dress, cook, transfer yourself around. I'm trying to think of the other.
Feeding.
Feeding. Yeah, you need assistance feeding. If you're cognitively impaired. And now a lot of times people might think, well, that's for older people, right? But what if you're in a major car accident? You know, what if you went to a major car accident and you cannot do any of those 2 things? We can accelerate the death benefit. And the last thing I want to say is this. Some people think that they don't need insurance. They say, well, you know what? When I'm gone, I'm just gone. But the problem with that is you don't just die. People don't just die. You get sick first. And when you get sick, you have to ask yourself the question, well, who's going to take care of me if I'm sick? Who's going to cook for me? Who's going to drag me up and put me in the shower? Who's going to do all those things if I can't do it? And yes, your loved ones will do it. I always ask people, which one of your children are going to move into their house, leave their family, and have to take care of you? What if you could just write a check and have a professional come in for 4 hours or so, do those heavy lifting things for you, and then now when your loved ones come by to visit you, it's just to cheer you up instead of stressing them out. So those living benefits are huge.
I mean, alongside of that, Donald, so what I see is the baby boomers are now 70, 80 years old. You can use those riders for assisted living. And I'm experiencing that now. I've got an aunt that she's been living with another aunt of mine, but she's at the point now where my aunt just can't take care of her anymore. She needs better care, and she needs 24 hours care. And so we've been looking at assisted living facility for her. And unfortunately, she just doesn't have, the riders or long-term care that, I wish she would have thought about many, many years ago. And so now, she's got to get Medicaid, and it's just. But if you have the foresight to want to take care of yourself and not really be a burden, then some of these riders that we're talking about, and honestly, they're very, very inexpensive, very inexpensive. Let's get those things for ourselves, so we're just not a burden. But more importantly, we can take care of ourselves. And so I didn't get a rider for my daughter, but I'm going to be getting one next week, of long-term care, because obviously for her at 23 years old, it's inexpensive. So I'm going to get that for her, and then she'll take that over, but she'll have that for the rest of her life. And the younger the better.
And let me just add, oh, I'm sorry. Go ahead, Joan.
Go ahead.
I was going to say a lot of our riders are free with our policies. They come included the terminal, critical, and the chronic. And the chronic is similar. When you think about, you can't do your daily activities by yourself. You need assistance with that. So a lot of times that's where people go into assisted living. So that chronic illness rider can also be used as a long-term, sort of like a long-term. We don't call it long-term, but it does. The beautiful thing about the chronic illness rider is that they send the check directly to you. They send it to you. And now if your little cousin or somebody wants to take care of you, that those funds were sent to you. You can pay them a salary out of that chronic illness rider that comes with the policy for free. So I just wanted to add that.
But more importantly, the nursing home or the assisted living facility, they're not making you sell your house. They're not taking your house from you. Right. And they're not dipping into all of your income, because they do a 5-year look back at your income. They say you've got the income. You can only come here if you use your own income, or if you have a house, take your house for your own care. And so that's the biggest issue I really see, is protecting your assets, because you might be thinking, I want to leave this house for my children. You need long-term care. You're going into a nursing home or a assisted living facility. They're taking that house from you. And then now there's nothing else left for your children. But if you take care of yourself now, like Donald said, some of these riders are absolutely free. I'm sorry, go ahead, Joan.
I was just going to say, in reference to the riders, some of these riders are newer. When I say newer, meaning in the past 12, 10 years or so. So people with older policies may not even have had the opportunity to have these. So my point is, it's very important to do a policy review with your new agent, with your former agent, with whomever, to make sure everything, not just your beneficiaries, but that your coverage is updated. So that if you have a policy that's older, that didn't have the components of the riders, of these long-term care riders, or these accelerated, or these living benefit riders, you want to update that policy. So I just wanted to make that point.
And so to that point, you guys can go to biglifefs.com, scrolling on the bottom. If you want a free policy review, go to biglifefs.com. Just fill out the form where it says get a free quote, and we'll be more than happy to contact you. We can meet face to face. We can do a Zoom call, talk on the phone, but fill out the form. Go to biglifefs.com and fill out that free quote, and we'll contact you to do a policy review. You might want to add a rider. Might want to. I talked to a buddy of mine. He said that he had he took out a policy, a whole life policy for his daughter, and I was telling him all the benefits of, or what I thought would have been better for her. And so he's setting up an appointment next week to meet with her. His daughter's like 5 years old now. Did you have a go ahead, Donald?
Yeah, I just had a real life story, and it occurred with my mother, who is she's resting in heaven now, smiling down on us. But she passed away at the age of 85. She lived a great life. She saw her 3 children all become young professionals. She saw her grandchildren, and you can't ask for anything better than that. But you know, I used to tell the story. Mama Williams, everybody knew Mama Williams. She have that white Jaguar. She come through the neighborhood with her smile. But in her last year or so, she was not the same Mama Williams. I had to actually take her keys from her. I said, Mom, you can't drive the Jaguar no more. You know, and then she started to develop Alzheimer's, and she later needed 24/7. She was on oxygen. So we had to move Mom's out of her house in DC. And that was tough. We tried to put her in with one of us. She didn't like that. And so she needed 24/7 care. So we found this great facility, assisted living home, $5,000 a month, Greg, $5,000 a month. Mom didn't have none of these living benefits or anything. But what she did have was that real estate. And me and my sister and brother came together. We said, okay, we got the house. We want to keep this house. Let's rent this house out. And we were able to rent the house out to help fund that $5,000 price tag that we needed. And now Mom's is gone. We still have the house. We're renting it out. But I love the whole concept of how Big Life ties real estate into the financial world, how we can come up with strategies to help people. Absolutely. But I wanted to share that story.
All right, so we've been talking this morning about helping the babies and the millennials build wealth, and kind of giving some ideas about how getting started at an early age, they can actually become millionaires. And so, Donald, let me ask you this. Let's say that we have someone 50 years old, fairly good health. What do we do with someone like that in terms of, cash value, helping them build wealth? It's not too late at let's say someone in their 50s.
Well, yeah, we first sit down with them and just try to find out what is their motive. What do they want? What do they want? Do they want to leave a legacy? Are they trying to, for their children, grandchildren? Do they want to build up cash? What they actually want? It's not too late. I just this week, and I feel so good when this happens. We submitted an application for this is a 60-year-old, 61-year-old. She got a preferred rating. That's one of our best ratings. So what does that mean? I always like to say, your health is your wealth. The better your health, the better we can get this money. I call insurance money. We can get it at a cheaper price for you. So by her having preferred, we are able to get her a lower premium, which will allow her to now build up more cash. So depends on the strategy. We can design these policies where you can just pay for just 10 years, 15, 20, 25 years, or, we can design them anyway. We just sit down with you, find your budget, and now it's a matter of what's the goal. And whatever you say your goal is, we can design a policy to meet that goal. And if you can't meet that goal, if it's not in your budget, we can even design it so that it can be in your budget today. And then if you got flexibility, if you got something going on, especially like a lot of entrepreneurs starting a business, maybe you're not where you want to be right now, but in 5 years from now, you have a projection, your business is going to explode. We can now alter that plan without having to go through any medical exams later on, and so that you can get more tax advantages or chuck more money into the policy. So it's really, everybody is totally different. Everybody has a different blueprint. Depends on where you are. And that's where we have to sit down with you and see where you are right now and then where we want to go in the future. But there's no one thing for everybody because everybody has a different financial blueprint, I like to say.
Can I add something to that, Donald? Some people, I think a lot of people are getting now or understanding that life insurance can be used to supplement retirement, used for generational wealth, a lot of things that are beneficial. We still have a small percentage of people who say, I don't need life insurance. I don't have any children. I don't own a home. So I don't care. I'm not going to get a coverage. You still have to be buried. And the average burial cost, and it varies by geography, but in this area, I think, correct me if I'm wrong, it's like between 9,000 and 13,000. Who's going to pay that? Somebody's got to pay that. And in death, your taxes still have to be filed. Somebody has to file taxes for you the year that you pass. So if you owe, there needs to be some money to handle, as my grandmother used to say, handle your affairs. So even if you don't think that you need retirement money, you're just going to live off Social Security. I don't know how in this area, but okay. You need to really think long and hard about your final expenses and how you can make that be a reality.
And that's a we'll talk about this in a minute, but you can just simply get a final expense policy to pay for those affairs.
Right.
And to piggyback on that, while you are healthy, if you got good health right now, you might say, I don't have a house, I don't have any children. Why do I need life insurance? I'm healthy. Well, as I always say, you don't just die, you get sick first. So if you got sick and you had living benefits, you can use those living benefits for who? For yourself, to help supplement whatever you're going through at that point. So again, your health is your wealth. While you got good health, try to get a policy with good health. Now, if it's later, your health is not good or you're much older, then yes, we do have final expense to cover those final arrangements for you, as Joan and Greg just spoke about. Yeah.
And so I want to touch on something that you said, Donald. I have, most of you guys know, I own a real estate company alongside of now with Big Log Financial Services. And one of my concerns, one of the reasons why I even got into the financial services space was to try to educate my real estate agents on retirement and different retirement vehicles. And one of the best retirement vehicles, because as a real estate agent, especially if you're full-time, there's no pension plan. There's no 401k, nothing like that. So you've got to create your own. Sadly, most do not. And so alongside with investing in real estate, which I've been preaching to my real estate agents for many years, we're going to have to get Donald to, before we start next time, get his set prepared. Donald, next time, get the whole set prepared before we go live, okay?
Then the sun came up. I had to put my umbrella on. So
Got your fire in the back, and I'm saying in my mind, well, Donald just keeps still.
Right. We know who the problem child was in school.
I hear every word. I hear every word.
You need medical insurance. You need to get some of that. What's it called? The ADD or what's that called? The attention deficit.
Ritalin so you can sit down.
But anyway, in your 40s, 50s, 60s, fairly good health, you can use an IUL for your retirement, and you can pay into it enough money so that at a certain age, and depending on how you design it, like Donald said, you can have a retirement coming in to yourself. Also, obviously, the death benefit, that money comes to you tax-free. And then you have the opportunity to get all those riders that you need for long-term care, things like that. And so when I was initially introduced to an index universal life policy, the person that introduced me to it only spoke about retirement. So I just thought it was for retirement. And so I purchased it for my daughter, just thinking, okay, if all else fails and she kind of doesn't do what I hope she does, at least she'll have a good retirement at 40 years old, 50 years old. And now, something that I want her to keep paying on as long as she can, so she can build up enough cash value so that she'll have $1 million. But I want my real estate agents to invest in products like this so that they have a good retirement when they stop selling real estate, because I don't want them selling real estate for the rest of their lives. And so you've got to put some strategies in place, and an index universal life policy is one of the best strategies for retirement. Let's shift gears real quick. Joan, let's talk a little bit about annuities. And so we're in a government area. We're here in the DMV. And so we have a lot of government workers. A lot of them are, their retirement is called a TSP, a thrift savings plan. Let's say that we have an individual that has about, let's just say $500,000, $500 to $1 million in their thrift savings plan. They come to you. What are some of the things that you would suggest to them?
Well, an annuity, some people may say, okay, well, what exactly is an annuity? Because we've heard the term kind of thrown around. We hear it associated with companies like J.G. Wentworth. So people don't necessarily understand what it is. But basically, it's just a contract between an insurance company and yourself. Here we go back to the insurance company. Again, just solidifying the power of insurance. And you use that contract for savings or for income, and it's a tax favorable mechanism. So basically, it's a retirement tool. Now, the federal government employees are in a unique situation because most of them will have 3 revenue streams of income in retirement. They have their pension or their retirement, they have their TSP, and then most will have Social Security. When you set up your annuity strategy, you can either decide, I want the money to be in for growth. So I just want to put it in there and just let us see how much it's going to grow. Or you can do it for income. Income means that at a certain point, you're going to get a defined amount of money, like an allowance, so to speak, every year or every month, depending on how you decide you want to get that distribution. Or you could do a combination of both. So let's say someone had $500,000, as you said, in their TSP. We want to look at, first of all, what their plans and their budget is projected for retirement. Are they still going to have a mortgage, and how long are they going to have that mortgage? We have to look at retirement dates. So if you decide that you want to retire at 62, you don't have to start taking Social Security just because you're retired. So you want to, if you can, wait until the maximum age of 70 to take that Social Security. So what does that mean for your other streams of income? Can you afford to hold off on the Social Security long enough to take advantage of the highest amount with your other streams of retirement income? So with that annuity, we can look at it and decide, okay, well, if we let it set till this amount of time, we can turn on this amount of income. You can take a 10% withdrawal every year on your TSP, on your annuity without any kind of penalty from the government. And that usually is a 1-year wait period. So if someone were to transfer their TSP money into an annuity, then they would typically have to wait 1 year, and then they can start taking that 10% distribution. If they took over the 10% distribution, so let's say they had $500,000 in the account, 10% of that's $50,000. One particular year, they took out $60,000. So they would be penalized 10% on the difference between the 50 and the 60, what they went above. So there'll be $1,000 penalty that they would have to pay. If you do the income, then you know for a fact every month I'm going to get a $1,400 check, whatever the numbers come out to be. And it's going to vary based on when you decide that you want to take income and how old you are based on life expectancy. Another thing to keep in mind with federal employees is that you're eligible to move that money from your TSP at age 59 and a half. So a lot of employees are still, or a lot of individuals are still working at 59 and a half. You can, while you're still working, transfer that money out of TSP into a private IRA, which would be your annuity, without any penalty. If you decide to wait until you retire to kind of exercise your options, you're looking at two different things. One is the FEGLI, which is your life insurance. The FEGLI is a term policy. Now, some people have purchased it so that it doesn't go away. Otherwise, if you didn't, and that's usually what I'm finding, employees who came into the government early on, like in the 80s, 70s even. A lot of newer federal employees did not select the option to have that FEGLI, keep that FEGLI, have it not diminish, or have it not diminish as long as they have it. But typically, FEGLI will diminish in value until it's, I think, 25% of what you originally, or what your highest amount was. That's on option A. On your family coverage, on your option C, that you can get 5 times the amount, that definitely goes away. No ifs, ands, and buts about it. You can't pay to keep it. So now you're looking at, if that's the only option that you have for life insurance, you're going to have to definitely do something to have some permanent coverage. So it's better to look at what you have now and get with someone that can get you some permanent coverage, and then you can start taking advantage of some of the benefits of that permanent coverage. Now going back to the TSP, their savings plan, is actual company. You can, when you retire, you can leave your TSP money with TSP. And basically just continue to manage your funds as you do when you're actively working, whether that's putting in a C fund, G fund, I, so on and so forth. You can do that. It's kind of hard, but you run the risk of, unless you carefully calculate, you can run out of money. And you don't want that to be. You don't want to have thinking, okay, well, I've got $500,000 in the account. I'll just, I'm going to take some money out and get a new car, and then I'll leave the rest. But then you find yourself, you pulling some more out because you've got a wedding that you want to pay for, or you've got home improvements, whatever the case may be. So fast forward, now you're 78 years old, and that $500,000 is now $30,000. Life expectancy could be 85. You're not going to be able to live on $30,000. Stretch it out effectively, between 78 and 85. So that's That's one risk that you take doing that. You could have one of the companies that TSP uses to annuitize that money. That's not very beneficial, because when you do that, what you're doing is trading the money that you have for guaranteed income. So I lose all control of that $500,000. I give you that $500,000. Let's say, Greg, you're the financial institution. I don't want to call any names. You're the financial institution. I said, okay, I'm going to give you my $500,000. And then you say, okay, well, great. Well, John, I'm going to give you $2,000 a month for the rest of your life. All right, that's great. That's fantastic. Well, what happens if I die early? When I gave you that $500,000, I was 62. I walked out and I was in a car accident on 495, and I didn't make it at age 65. There's still hundreds of thousands of dollars in that account. In this instance, it will not go to my beneficiaries because I have agreed to swap that money out. That money now belongs to Greg, and he's like, oh, well, so sorry, Joan. Next. Versus when you have it in a private IRA, whatever money that's left in that account, even if you have turned on the income, will go to your beneficiaries. And of course, the other option that you absolutely do not want to exercise as a federal employee is to take that money out as a lump sum, because you're going to get hit with a very high tax rate on that. So that shouldn't even really be an option. It's an option, but never exercise that. Versus, so now, if you take that money when you're able and put it in a private IRA, you have all the benefits of participating in up markets. Just like with the IUL, there's a zero floor. So meaning when the market goes down, you just stay where you are. You can take self-distributions, meaning the 10% withdrawals every year. Or you can decide, okay, I want to take part of it and turn it into a guaranteed income. Just so I know, I'm going to take this $1,400 a month that I'll take that for 10 years. And I'll use it for an investment property, or I'll use it to, help my 30-year-old and their family. So there's so many things you can do with it, and any money that's left when you pass will go to your beneficiaries.
And so, Joan, I think the biggest concern for a federal government worker is to make sure that that money in their thrift savings plan goes from that qualified account to another qualified account in a way that they don't outlive that money. And so we can sit down, you can sit down with them and just see what their needs are.
Mm-hmm.
And because there's different types of annuities, but really kind of see what their needs are and design a program with their annuities so that they don't outlive that money.
Right. So like I said, with federal employees, because they are in the unique situation of having the pension and the TSP and possibly Social Security, depending on when they came into the government, then they may not need it for income. They may be okay just taking the distributions. Maybe they don't want to take distributions. If it's coming from a qualified plan, though, meaning that it was pre-tax, you will be subject to RMD, which is the required minimum distribution. And that amount will come to you. They will tell you how much you have to pay because it's based on how much is in your account. That will start at age 72. Money came out of your checking account or from a trust. That's non-qualified money. You can do a Roth, and then you're not subject to RMD.
And so I have seen some buddies of mine that have done very well in retirement, and they actually make more money in retirement than they did when they worked in the federal government because they put their money into the right plans. Also, they switched over their FEGLI at early in their career. We all know that the federal government, FEGLI is Federal Employee Government Life Insurance.
Uh-huh.
It's a group term policy, which means it's temporary insurance. And so the older you get, the payments go up, the premium goes up, and then the coverage goes down.
The premiums actually on the FEGLI start to go up. You see your biggest increase at age, I think it's 52, I think. It starts going up like 2% every month. So I had someone recently that was paying 200 and some change every month on their FEGLI.
It's payroll deducted, so they don't even know it.
Yeah, right. I mean, they see it on their pay stub and they're like, okay, well, I'm thinking I've got, $400,000 of coverage. So, okay, yeah, I'll pay the 289. Not looking at the big picture that this is going to diminish I'm going to have at a certain age, at age like 70 something, when you actually need it the most, this person would have had like $30,000 in coverage that they're paying $200 and something a month. So we switched them. We got them into a permanent coverage and did more on the cash value than on the face value, so that they can supplement that retirement, that fund, and use it for other things.
So the other things are, and so let's say, I think you said it was $289 a month premium. Mm-hmm. The alternative, and it's a term policy. The alternative to that is either a whole life policy where the payments are level, the same payments, it's not going to go up, or if they're in good health. Donald, what could you do with the $289 a month premium, switching them over from FEGLI to an IUL? What could you do with that? Depending on their age, depending on their health, they could really start building wealth coming out of the FEGLI into either, depending on their health, a whole life policy where there's no medical, or an IUL. And then having that IUL go alongside of that annuity that they're going to transfer over from their TSP. What could you do with that?
Before he answers, let me just add that with the FEGLI, you can change that at any time. You don't have to wait until your retirement age or 59 and a half. You can do that anytime.
They're wasting money now, but what could you do with $289 a month in premium that they're already paying, that's payroll deducted? We can go ahead, Donna. What can you do with it?
Yeah, it's funny you say that, because I actually got a client I'm working on right now, and she actually reached out to me, and she let me know that her FEGLI was getting ready to go to about $317 a month. Like right now, she's paying $214 or something, and she's saying that come January, they're going to raise it to $317 a month. So yeah, even though it's payroll deducted, they notice when that big jump comes, And the unfortunate thing is that's going to keep occurring almost every 5 years. It's going to keep going up, up, up. Eventually, they won't be able to afford it when they mostly need it. So yeah, we could take that money now. We could switch those payments that we're doing FEGLI and look at what would happen if we put this in an IUL and just do a design and give. I always tell people you need to have it on paper. You get your plan on paper. Just like when people retire, I'll ask people, well, how much do you want to make in retirement? They say, well, I want to be able to have $100,000 a year in retirement. And, let's say they got $500,000 in their TSP or whatever. Well, if you just do the quick little math, if I just took out $50,000 a year off of that $500,000, that's going to last me 10 years. And by the way, that $50,000 I got to take out, it's going to get taxed because that hasn't been taxed. So let's say they take out 25%, you're looking at living on $37,000 per year, which is roughly about $3,000 a month. And if you don't put that on paper and realize that, like, that might not be enough for you to only be living on that much, and then it's gone in 10 years. So annuities are great. They're designed to make your money last forever. That's what they're designed to do. They're designed, put your money in an annuity. We can make that money last for a lifetime. IULs are designed to accumulate cash. That's what they're for. If I want to accumulate, I want to put in an IUL. If I wanted it to last forever, that means I got a lump sum. I might roll into annuity later on. So I would definitely put, and again, everybody's blueprint is different. You got to sit down with each person, but I would look into putting, designing an IUL for that individual and seeing how, and we project out 20, 25, 30 years and see what's a better option, if that's a better option for them.
You know, Don, with the, now don't sell the annuity short, because the annuity is not necessarily, is not just, okay, well, it's gonna, if you turn on income, that's the only way it's gonna last forever. It really depends on how much you're putting into it and how much you need to withdraw from it. So if someone has $500,000 to put into an annuity, and I'm not saying don't forget, you know, to forget the IUL, but if, let's say they have $500,000 in their annuity, they also have Social Security, they also have their pension, and let's say their pension is another, because they've been in 20 something years, their pension, and based on their income, is $6,000 a month. They can afford to let that money stay in that annuity, into that IRA, and only take the minimum, live off the RMD, and pass that on to their heirs. And now their heirs, they have the tax deferred benefit just like the original owner did. So there are still some really great benefits to doing the annuity. And
right. And let me answer this for me, Joan. So, and I know we were talking about FEGLI, right? Mm-hmm. And those individuals in the federal government and in certain sectors still get a pension, but a lot of people don't get pensions, right? There are a lot of people. So when you don't have that pension option, all you have is just your 401k.
Right? Well, we're talking about federal government. So
I know, right.
Most of them after even before 1984, most of them, ones I've seen, they've all had the pension. Now, depending if you came from a contractor and then switched over to permanent, you may not have that pension, or may not be that much in it. But the vast majority will have the pension and the TSP. And then, of course,
the vast majority will have the pension. Probably the vast majority now were in SERS, but you know, they started FERS around 84. Okay, around 1984, and so more and more people will have less pension and more TSP because they're in the new program.
SERS have more pension than the FERS, but they don't have. A lot of them don't have Social Security.
Right. But I do want to speak to, and so that was really good for the federal government workers. If you guys, federal government workers, if you guys want us to take a look at and kind of sit down with you one-on-one and explain to you exactly what you have in terms of your TSP, in terms of your life insurance, FEGLI, go to biglifefs.com, fill out the information to get a free quote. We'll sit down and explain it to you. I want you to build wealth while you're working in the federal government. And the way to do that is, one of the ways to do that is your life insurance is payroll deducted. Let's put it into a policy that's going to allow you to gain wealth. I mean, that's just the bottom line. And then start preparing you for retirement with your thrift savings plan. Hopefully you guys have been maxing that out, especially those of you guys that are in FERS. I mean, if you're in SERS, you can contribute to the TSP also, but the government doesn't match it like they do if you're in FERS. Let's speak to the people that aren't in the federal government. Let's say two different. One has they're in the private sector. They have a 401k. They've kind of been sitting on it. Maybe they're not doing anything with it. They've been going from job to job. Joan, what do you recommend for people like that?
That's really good point. So a lot of times, because we're in an industry and in a time that, you know, people don't stay at one job for 30 years. Every 5 years or so, 3 to 5 years, people switching jobs. So what if you are in a situation that you were at job A, and you're participating in your 401k, you got a job offer for somewhere else, and you just left your 401k there at the old job. It's still your 401k. That's still your money. So what you can do, you still, just like what I was saying with the federal employees, you have the ability to move that into a private IRA. As long as you don't take that check payable to Joan Lane or whomever you are, you don't face any penalty. When you have it in a 401k, you have no control over the management of that fund. Whoever that administrator is going to decide where they're going to invest that money, how much is going to go to each diversification of it, if there's any diversification. You're just along for the ride, and you're participating in profits and the losses. Move it over to a private IRA, into an annuity. You have control. You decide. You sit down with your advisor and decide what strategies you want to put it in. And then you have that fixed floor. You're not going to lose any money. You might have you're going to have some 0 years. It's just the way it goes. But some years you're going to have double-digit growth. Some years you're going to have single-digit growth. But you can expect a compound return somewhere between 4 and 6%. And kind of put that in real numbers, because compound interest is hard to understand. I don't want people, sometimes I've had people say, oh, well, 4%, that's nothing. I mean, why would I put my money in there just to get 4%? It's compound, and it's an average. Again, some years you're going to have a 12% return, a 20% return. Some years you may have a 5% return. Case in point, I had very recently a client who had a small retirement fund. It was like $40,000. It was less than $40,000. But they put it into an IRA, and based on the strategies that we selected, it's projected in 10 years to be at 100,000. Now, you're not going down to ABC Bank and have that happen. You're not going to necessarily have that happen if you just invested in the stock market, because if you invest in the stock market, while you are participating in the gains, you're participating in all the losses. So just like with your 401k and your private account, or when you're working for a private employer, when the market goes down, you can lose half of your money in your 401k. Even in your TSP, if you're investing in C fund or I fund, one of those more aggressive funds, you're going to participate in those losses. So you want to put your money somewhere where it's safe, where you don't participate in the loss, but you're participating in the growth.
All right, so let's kind of wind down. There's a couple questions. Deborah is asking, why do some people not have Social Security if they have worked and have enough credits?
With the federal government, they just didn't, the way it was set up, they didn't allow for those employees to participate in Social Security.
Right, and that's just the federal government, correct, Joan? I mean, if you
no, it's also police officers.
Okay, but they're getting some other benefit if they don't get Social Security, correct?
No, they have their TSP equivalent, and then they have their retirement. There's some teachers are in that, so it just depends on, some federal and some municipal employees do not have Social Security.
And so Deborah is also saying 4% is great compounded. And so we've got to understand really what compounded interest is and the power of compounded interest. It always reminds me of what Warren Buffett said. He said compounded interest is the eighth wonder of the world. And he told his wife in his 20s that he said, because of compounded interest, if I live long enough, I'm going to be the richest person in the world. And there was a time where he was. It's because of compounded interest. It's almost like money on top of money growing.
There it is. Mm-hmm.
And so 4% compounded is excellent. But you do take advantage. So there's annuities where, just like the IUL, where you take advantage of market gains, but not the losses.
Those are fixed. Those are called fixed.
Let's see. Arlene is saying, it says the FEGLI policy value starts to decrease at age 65.
That's right.
25%. No long, but you're not making any more payments. So if you keep it that long, we're not saying to get rid of it, but we're saying that there's a better alternative. And so
I disagree with you. I don't see the point in keeping it. If you have, why would you continue to put money in? Because the premiums, they go up. The value, the face value is decreasing, but that premium is increasing. So why would you continue to put hundreds of dollars every month? So if $200 a month, what is that? $2,400 a year? Is my math right?
Yeah.
$2,400 a year.
Well, Joan, all I'm saying is if we do have someone that's 65 or older and or close to that age, it doesn't make sense for them to get rid of it because they have a policy. They're not making any more premium payments. I do suggest that they get something else also.
Right.
But if it's someone that's in their, let's say a federal government worker in their 20s, 30s, 40s, even 50s, yes, absolutely, totally get rid of it. With those payments that you're making, we can give you a payment that's level. You're making one payment that never changes, but that's also giving you cash value.
Right.
And it's permanent insurance. Obviously, depending on your medical condition, we can get you something better, but we could even get you a whole life policy that gives you cash value and you don't need a medical on it. And so we have a product through, I think it's American Amicable, that has that product. And so, but if you're 62, 3, 4, 5, you might as well just keep it because you're not going to have to make any payments. And it is a term policy, but we can also.
I think if you're I agree with you, but if you're at the point that you're still making payments on it and you're 50, 30, 40, 50, whatever, get out of it. Cut your losses.
Get out of it and look into getting a permanent plan, an IUL, preferably with living benefits.
Mm-hmm.
See, though that FEGLI has no living benefits at all.
No.
So now we're talking about being able to have death insurance plus living benefits. My premiums can be locked in, and the longer you live, the greater those living benefits become. The longer you live, the greater the death benefit can be. It's not going down, it's going higher. Everything is going higher the longer you live in those policies, the more value they have.
Plus that IUL for the government worker, when you exchange that IUL, of that FEGLI for an IUL, gives you another opportunity for retirement, depending on if you overfund that IUL. Let's see. It said, is there any way to group health insurance with a life insurance policy? Wouldn't the entrepreneurial journey require private health insurance as well?
They are separate. So if you get a life policy, and if I'm understanding the question correctly, there's no dual life and health policy.
But for an entrepreneur or small business, we here at Big Life have a great supplemental health insurance that is not true 100% health insurance, but it's a great supplemental that can provide some benefit if you have to go to the hospital, if you have to catch an ambulance, if you got they have what's called cancer policies, stroke policies, and so critical illness policies. So we do have some some great supplemental insurance for any business, 1099. We have something to help you here at Big Life. Absolutely.
But we do have a policy through Washington National that it's a combination policy where it is supplemental insurance, like what Donald said, and you can also alongside of that get a whole life policy. So it is a combination group health and life insurance policy. The payment is probably as low as $200, depending on what you choose for the supplemental health insurance. But it does also come with the life insurance policy as well. Those are primarily designed for either individuals that don't have any type of health insurance. It's designed for entrepreneurs that need some type of health insurance and really can't afford major medical. And so we do have that combo package that has the life insurance and supplemental insurance. But the supplemental health insurance it's good. It's telemedicine, dental, eye, but it's not major medical insurance. All right, let's see. Got a couple more questions. Arlene, if you're close to 60 when you retire, I would continue paying premiums and have a paid up policy. If younger, I agree, get out. Oh, I think she's referring to the federal.
Yeah. But why would you? Okay, so that's Arlene. All right, so if let's say you're 59, and your premiums have already started going up, and just asking, what's the benefit of continuing to pay $200-300 a month for a policy that's not going to be worth this? The face value is going to decline. So it's not like you're going to continue to pay the $200,000 and have the $300,000 of coverage, or whatever the face value is. It's just like the depreciation on a car. As soon as you drive it off the lot, it's not worth that anymore. So what's the benefit of continuing to pay that amount, knowing that you're going to get much less?
Yeah, Arlene, be nice to Arlene. She's one of my agents.
No, I'm not trying to be mean. I'm just trying to talk it through.
But Arlene, yeah, I mean, so Joan is right. I mean, it doesn't make sense to continue. I agree. I mean, if you're 64, 65, I mean, you can have that insurance. But let's say you're 60 years old. Why pay for another 5 years, FEGLI, where that payment is going to go up, your coverage is going to go down. You can get permanent insurance depending on your health. You can get permanent insurance that's going to give you more coverage. The payments, the premiums are going to stay the same. Call it level. It's going to stay level. And it's going to give you some cash value. And so I would recommend coming out, but I'll call you. I'll call you.
Paying $2,400 a year over 5 years. That's what, 10 grand? That's more than 10 grand.
Be nice to Arlene.
I am. I'm being nice to you, girl. I'm looking out for you.
All right, couple more questions, and I'll get you guys out of here. I know so many of my peers who haven't considered this yet. I'm excited to bring this to you. You guys are bringing this to them. Good. And so that's what this is all about. We're going to try to actually do these in another 30 days. You're going to try to do these at least once a week, because I think, like Deborah said here, our community really don't know about IULs. Other than here, I've only heard about it in other communities. So thanks to Big Life. And so that's part of the reason why we even created Big Life Financial Services, is to get this information out into the community, because our community is underinsured. And one of the reasons why is because there's a myth with insurance that it either costs too much, or it's only for when you die.
Right.
We don't realize that this insurance is really for the wealthy, and it's how many millionaires build wealth. And they're using insurance money, the cash accumulation, to be their own bank and to finance their wealth. And so we have to teach each other and teach our community how to do that. I'm teaching my daughter how to do that. As I said earlier, she's going to be buying an investment property using the money, she's being her own bank at 23 years old. And so, but I started her like at 10 years, about 10 years ago or so. And so we've got to educate. And so we've got to self-educate. So I appreciate you saying that, Deborah. We've got to get the word out. And so that's the purpose of one of the purposes or missions of Big Life Financial Services is to get the word out. And this is one of the best ways. And I said earlier, my background is real estate investing. When you combine the real estate investing with the insurance and using your insurance cash value to invest in real estate and be your own bank, it's just nothing better. All right, a couple of questions. Go ahead, Donald.
I just want to add, you know, a lot of times you just only know what you know. You only know what you know. And I would recommend folks get a policy review. A lot of times we purchase these policies, we see the cute little commercial on TV, the little baby, and we go and get that little baby policy, or we see the $9.99, the $9.99 man, and we go and get that policy, and then we just chuck it away, and we really don't even know the terms of it. We don't know how it's growing. We don't know anything. What if we just did a policy review, give you some financial education, tell you how your policy is growing, let you know a little bit more, and then show you some solutions, some other options. Get a free policy review with Big Life. Let us and get educated on it, and put yourself in a better position. So we love being able to provide the financial education with a policy review and just help folks out. I just wanted to add that, Greg.
And so, you guys, we're getting a lot of positive reviews, and so I'm glad we did this morning. We have to educate. And so what I tell my insurance agents, you guys, is we've got to do good, and we've got to do good by the community, and we've got to do the policy reviews, but then also educate people on new policies that they're taking out, so that they can build wealth for themselves and their family. They're not leaving their families in a situation when they pass away that there's no more money in the family. And so I tell these guys this story all the time, that when the head of household in our community passes away, all the wealth passes away with them. And then so now we're seeing GoFundMe pages and things like that. In the Jewish community, when one passes away, 2 millionaires are created. And 2 millionaires are created because they understand wealth. And they understand the power of insurance policies. And so we just have to get there. And I think the more we talk about it, the more we're out in the community talking about it, the better off we all are. And then we just have to stop looking at insurance as, something that is only for the deaf, or like Donald always says, you got to get sick first, and who's going to pay for that? And so, Donald, that story you told, Donald, really touched me, because you said that you and your siblings took the house and rented it out and was able to supplement your mother's care. That doesn't happen normally. Normally, the nursing home or the assisted living facility, they go and take that house and sell that house and use that money to take care of your loved one. So there's nothing left. I'm not going to say suck and dry, because that's not fair, because the care has to be paid for. But that's what they do. And so we've got to stop that. We've got to stop that vicious cycle of not preparing ourselves financially, being a burden on our loved ones.
Another thing is that it's a mindset, because I've explained the benefits of using an IUL to some people, and you have one person that's really excited about it, and then they go tell their friends, and they're like, I'm going to wait and see how it works out for you. They don't believe. They're like, okay, well, that's not for me. That's not for someone like me. That's for someone like in other communities. Money is money. It's the mindset. Once you understand how to use the tools, we're going to give you the tools. Let's put them to work so we can get you what you want, whether that's a comfy retirement, whether that's lifestyle, whether that's generational wealth, whether it's all of the above. it can happen, and it can happen for anybody. But we want to make sure here in this forum that our community, who's been underserved, undereducated, that we get you what you need, and it's on you to make sure you got to do your part. We're going to do our part, but you've got to do your part.
All right, you guys. It's 10:30. I appreciate any last words, you guys. Any last words?
I'd just like to say, I hope that we continue to do this, provide this kind of information for our community. Have a plan B. You need to have you got a plan A, but life is full of a journey. Life is a journey, and you might just have this one plan, but have a plan B. And that's what we want to, we can sit down with you and give you a plan B. Have a plan on paper, get it on paper, right? And so have a plan B, and also, you might even be looking for additional income. This opportunity here, Big Life, where we combine financial services, final expense, Medicare, supplemental insurance, even assets under management, IUL, all of that under this one Big Life umbrella. You can earn some additional income, can be a plan B also. And we got a great startup program for brand new people that want to get into this industry as well.
So thank you for that. Don, you guys can go to joinbiglife.com. Let me see if I can show this. Oh, I can't. Okay. Maybe I can. Let's see.
Thanks, Deborah.
Yeah, you can go there if you're interested in getting into this industry. Again, our community is underserved. Part of the reason why we're underserved is because only 4% of all insurance agents, 4%, you guys, are people of color. And so we're not getting out into the community. And so there's a lot of business out here, people to serve. So if you're interested, go to joinbiglife.com, schedule an appointment to meet with us. You can be on our next webinar next Thursday, live webinar, but go to joinbiglife.com. Go ahead, Joan. Any last words?
No, I just want to encourage everybody that we're here to help. There's a wealth of knowledge, and we're always Greg, Donald, and other members of the Big Life team.
Kenny, we have a guy named Kenny too.
It's our job to make sure that let me get you, Greg. Our job to make sure that we stay on top of ever-changing compliance issues, new products, things that are changing in the industry. And it's our hope that we just want to make things better for people, especially our community. I don't want to drive that. I do want to drive that home just as much as I can, because I want us to be where other communities are. There's no reason that probably anybody on this call can't go to another level. Even if you're already here, there's no ceiling, right? So you can always go to the next level, and we want to help you do that.
Okay. Well, I just want to thank you guys, Joan, Donald, for just really delivering, the information and the knowledge that you guys have. You would have thought that you guys were getting paid for this, but hopefully you didn't think
we're not.
But I do think it's important that that we get the word out, and so we're going to do this, eventually every week, and just touch as many lives as we can. As the gentleman said, you do better when you know better, and so we're going to get the word out. The excuse is not going to be that you guys out here don't know, because we're going to make sure that you know how to build wealth. Insurance is one of the more inexpensive ways, you guys, to build wealth, to build generational wealth, to become a millionaire. There's millennial policies. There's $1 million baby policies that we can write for you, that eventually you'll have over $1 million in your cash value account. And so it's all up to you. Let's all of us live up to our fullest potential. And then some of this, you guys, honestly, is sacrifice. And so for some of you, you got to sacrifice $100 a month, $200 a month. For some of you guys, $300 a month, and for some, that's just a Saturday night out to build long-term wealth. And then, but alongside of all that is all the riders and stuff that we talked about, critical care, long-term care, all of those things that you really build, just really a lifetime of financial security.
Let me just say to that point, Greg, a lot of times people say, well, I'm not really worried about it. I make six figures on my great government job or in my entrepreneurial endeavors. I'm healthy. I don't need to put in, this extra $300. You're not going to stay young forever, and anything can happen. And even with insurance, just basic health insurance, if you get diagnosed with cancer, you can still have hundreds, 200, I think it was like 200 and something $1,000 of expenses that are not going to be covered by insurance, by health insurance. If you don't have the leave, you're going to be sick. So they'll grant you, they'll hold your job. But let's say you are out of income for 6 or 7 months and your savings account, because you always thought the money was going to be there and you live in Gucci, where's that money going to come from? So now you have expenses that your health insurance aren't going to cover. It's very important that you have somewhere a tool, a mechanism, such as a life insurance policy with living benefits that you can go to fill in that gap. And then after you get yourself back on track, we're going to get your budget back on track so that you're saving money or having money in a place that when you need it, is liquid.
Yeah. All right, you guys. Have a wonderful weekend, everyone. Hopefully the weather's nice. If you guys want to talk more about what we've talked about, just go to biglifefs.com. Just fill in the quote, wanting a quote on a life insurance policy, or fill that in if you want us to do a policy review. Again, if you're interested in selling financial services, either full-time or part-time, go to joinbiglife.com. We want to do good by our community and just really raise our community up financially, but raise you guys up individually. All right, Joan, Donald, appreciate you guys. Have a wonderful weekend.
Bye, everybody.
Talk to everybody soon.
Bye.
Have a good day.